The stock market just hit a record high. Your bank account just hit a record low. And somehow, both of those headlines are about the same economy. You did what people told you to do. School, degree, job applications. Maybe you finally got hired, but after rent, groceries, insurance, and one random car repair, your paycheck is basically gone. Maybe you had to move back in with family and keep telling yourself it's temporary. Then you open your phone and see, stock market hits another record high. And you think, record high for who? Because it definitely doesn't feel like good news when you're trying to stretch your paycheck until Friday. Here's the part most headlines leave out. The stock market can hit a record high on the same day your job becomes less secure. And that's not necessarily a contradiction. One number measures what investors think large companies are worth. The other is whether you can afford rent, find stable work, replace a tire, or breathe after paying your bills. Those things don't show up on the same chart. So before you decide you're falling behind, we need to separate the economy on television from the economy inside your bank account. Because once you see the difference, you stop using somebody else's scoreboard to decide whether you're failing. Let me tell you about someone who's 27. They've applied to 80 jobs, half never responded. One company made them sit through 4 interviews, asked them to do a sample project, and then froze the position. They finally find work, but the salary barely covers a 1-bedroom apartment in their city. So they move back home, not because they're lazy, not because they're bad with money, because spending 70% of their income on rent would leave nothing for emergencies, debt, or an actual future. And maybe that person isn't imaginary. Maybe it's you. Now, here's what makes this harder. People show the promotion, the apartment keys, the vacation. They don't show the rejection emails, the credit card balance, or the conversation where they admit they can't afford another year of rent. That hidden part matters, because comparison can turn a difficult situation into a personal failure. You see somebody your age moving forward and assume you must be doing something wrong, but you don't know who paid the deposit. You don't know what debt is behind the pictures. You don't know how many safety nets caught them before they landed where they are now. Now compare that person's life with the stock market headline. The headline isn't measuring how hard it is to get hired. It isn't measuring how many people moved back home. It isn't measuring whether payday is 3 days away and the groceries are going on a credit card. It's measuring what investors think large public companies are worth. That's it. The market can be doing great while your personal economy feels terrible because they aren't the same economy. Headlines say, the economy is strong, show a green chart, and move on. Meanwhile, you're staring at your bank balance wondering what part of that strong economy you're supposed to be living in. The disconnect isn't just frustrating, it's dangerous, because it makes you feel like you're the problem when the scoreboard was never designed to measure your life in the first place. And here's where it gets even more messed up. Sometimes the exact decision that helps a company's stock price can make your next paycheck less secure. A large company has options you don't have. If costs rise, it can raise prices. If profits fall, it can cut jobs. It can automate work, move operations, or restructure entire departments. You can't restructure your grocery bill. You can't lay off your rent. You can't tell your student loan payment that this quarter was challenging and you need to downsize expenses. A company can improve its numbers by making decisions that make your life less secure. It can announce layoffs in the morning, watch its stock rise by lunch, and call the quarter a success by dinner. Investors see lower costs. The person losing health insurance sees a rent payment coming in 2 weeks. That doesn't make every company evil. And it doesn't mean every layoff causes a stock to rise. It means the incentives are different. The market rewards decisions that investors believe will improve future profits. Workers often live through the other side of those decisions. That's how a green stock chart and a layoff email can show up on the same day. Let me give you a real example. A tech company announces it's cutting 10,000 jobs to streamline operations and focus on AI. The stock jumps 8% in one day. Analysts call it a smart move. Investors celebrate the cost savings. Meanwhile, 10,000 people just lost their income, their health insurance, and their ability to plan more than 2 months ahead. They're not thinking about quarterly earnings. They're thinking about how to explain this to their family, whether they can keep their apartment, and how fast they need to find another job before savings run out. Both reactions are happening in the same economy, but only one shows up in the headline. So when the market reaches a record, it doesn't mean everyone is moving forward together. It may only mean investors expect the biggest companies to keep making money. The market isn't ignoring your struggle. It was never designed to measure it. And that's the part nobody tells you when you're growing up. You're told to work hard, get good grades, go to college, get a job. You're told the economy is doing well when certain numbers go up, but nobody explains that those numbers can go up while your life gets harder. Nobody explains that record profits and we can't afford to give you a raise can both be true at the same time. Nobody explains that the economy on television and the economy inside your bank account are two completely different scoreboards. And once you realize that, a lot of things start making sense that didn't before. You finally save $1,200. Then your car needs repairs. You finally pay down the credit card. Then your hours get cut. You finally think you can move out. Then you see the deposit, application fees, and income requirement. You're not failing to make progress. Your progress keeps getting reset. And after enough resets, you stop trusting it. You stop making plans because every plan depends on money staying untouched. And money never stays untouched. Maybe you're living with family again and trying to be grateful, but it's still hard. You have less privacy. You hope people don't ask where you're living. You keep saying it's temporary, but you don't know what temporary means anymore. That's why this isn't just a budgeting problem. It becomes an energy problem, a confidence problem, sometimes a relationship problem too. Because when you can't build anything that lasts, you start to wonder if the effort even matters. And this is where most financial advice loses people. Just save more. Just invest early. Just stop buying coffee. Okay, but coffee isn't why a basic apartment costs half your paycheck. And one takeout meal isn't why rent, groceries, and insurance all showed up ready to fight you at the same time. That doesn't mean spending doesn't matter. It does. But small cuts can't fix a giant gap between income and basic expenses. If your essentials cost $3,000 and your take-home pay is $3,100, skipping coffee isn't a complete financial strategy. It's not even a noticeable one. That's why you need honesty before motivation. Maybe your spending needs work. Maybe your income is the bigger problem. Maybe you need a cheaper living situation for a while. Maybe all three are true. The useful question isn't, why am I so bad with money? It's, which change would give me the most breathing room this month? There are choices you can control, and there are pressures you didn't create. Handle the choices you can control. Just don't blame yourself for pressures you didn't create. But here's the thing that worries me most. When people feel stuck long enough, they stop trying to build anything. They see the stock market hitting records while their rent keeps rising, and they think, what's the point? And emotionally, I get it. The system feels rigged. The headlines feel like they're describing someone else's life. The advice feels useless when you're just trying to make it to next Friday. But financially, giving up can cost you more than the unfairness already has. Here's what I've seen working around retirement plans for years. People at nearly every income level feel behind. Some were supporting family. Some were dealing with medical bills. Some were starting over after a divorce, a layoff, or a bad financial decision years ago. A lot of them stopped contributing to their 401k when money got tight. Then years passed. They never restarted because the amount they could afford felt too small to matter. And that was usually the bigger mistake. Not that they started small, that they believed starting small didn't count. They'd look at someone with a huge balance and think, what's the point of me putting in $50? But $50 isn't supposed to make you rich next month. It's supposed to change what you own years from now. The first few contributions rarely feel exciting. You check the balance and think, that's it? Yes, that's it for now. Building wealth feels slow at the beginning. Social media shows you the final number. It rarely shows the years when the account barely moved. But here's what those years actually do. They create ownership. Not of your job, not of your apartment. Ownership of pieces of the economy that keeps growing while your paycheck stays flat. And the people who benefit most when the market hits a record high are the people who already own a piece of it, even a small one. No, that's not fair. But refusing to participate doesn't punish the system. It only keeps you outside it. You don't need to love the game. You don't need to think it's fair. You need to understand enough of it to stop getting locked out. So forget the perfect financial plan for a minute. If money is tight, there's a more useful order to follow. The stock market hitting a record high doesn't mean you should feel rich. It doesn't mean jobs are easy to find. It doesn't mean rent is affordable. And it doesn't mean you're doing something wrong because life still feels difficult. It means investors expect large companies to keep earning money. That can be useful information. But it's not a judgment on your life. You need a different scoreboard. Did you avoid adding more debt this month? Did you save your first $100? Did you apply for more jobs after the last 10 ignored you? Did you finally open a retirement account even though the balance looks tiny? Did you move back home and give yourself a real chance to rebuild instead of pretending you could afford independence? That counts. A credit card balance getting smaller counts. One interview completed counts. 1 month without borrowing from the next paycheck counts. Those numbers may look tiny next to a record high stock market, but those are the numbers that change what happens next in your actual life. Progress isn't always a big leap. Sometimes it's simply having one more option than you had before. One less thing controlled by fear. One decision you can make without checking your balance first. It may not show up on CNBC, but if even one of your numbers is moving in the right direction, you're not standing still. And here's the part that takes the longest to believe. Small, repeated actions in the right direction can eventually give you what one perfect decision never could. Stability. You're not trying to get rich overnight. You're trying to make one bad day less powerful. You're trying to build a life where an unexpected $500 expense doesn't destroy the next 3 months. Where moving out is a choice, not a fantasy. Where you can take a job you actually want instead of the first one that says yes. That's what financial progress actually looks like for most people. Not a stock portfolio that doubles overnight. Not a viral side hustle. Not a wealthy relative leaving you an inheritance. Just enough room to breathe. Enough saved to survive one surprise without starting over. Enough ownership in something, even a tiny retirement account, so that when the market does hit a record, you're not just watching from the outside. So if the market is hitting records while your life still feels stuck, remember this. You're not looking at proof that everybody else figured life out. You're looking at a number that measures something completely different. Your real scoreboard is your debt coming down. Your emergency fund growing, your income improving, your first investment, even if it's $50, your plan to move out, rebuild, or stop living one emergency away from starting over. That progress may never appear in a headline, but it counts. You don't need to fix your entire financial life this month. You need to make the next decision that gives future you more options. And if you've ever wondered whether your retirement balance is actually behind, that's what we're breaking down next. I'll compare the average and median 401k balances at 25, 30, and 35 and explain why those numbers can give you the wrong idea about your progress. You'll see what those balances really mean, which number matters more than the average, and what your next move should be, even if your balance is nowhere close. No judgment, no panic, just the numbers, the context, and a plan you can actually use. Subscribe to Max Stats Finance so you don't miss it, and I'll see you in the next one.